If anyone tells you that they have a perfect investment that's guaranteed to increase and you will never lose money, you should close your laptop, tie your shoes, and run in the opposite direction as fast as you can. Loss is inevitable. It happens. But it's also natural. This is baked into how your brain works. But we shouldn't let that fear of losing money overpower our investing or wealth building intentions.
You kind of hit the nail in the head when you talked about our wiring. These are well-worn neurological pathways that go back all the way to prehistoric times. And then on top of that, they're reinforced by some of the savviest marketers in the globe through digital marketing and, advertising. So basically, your brain is going to do what it does. And you almost have to rewire it and apply the same huge levels of effort to make it do something different.
Welcome to the Rich and Regular podcast presented by Success, where we explore life at the intersection of money. I'm Julian.
And I'm Kirsten. Today we're talking about overcoming the fear of losing money.
I feel like we need to add like some horror music or something.
Dun, dun, dun.
I was going to say Candyman. I don't want to freak people out.
Oh, no. You can't say that.
Candyman.
But speaking of Candyman, I feel like everyone should have a short list of justifiable fears. Candyman certainly belongs on that. And losing money, I think, definitely belongs on the list of justifiable fears.
Yeah, definitely. Losing money is not fun. It is frightening. And it's one of the... it seems like a bit of an about face because our last podcast episode was all about joy. It's like
I know.
The complete reversal.
Keep you on your toes.
Yeah, we're totally playing with your emotions here. But this one is really about the other end of that spectrum in terms of feelings. And obviously, losing money is scary. It's not fun. It is not an enjoyable feeling. And it's one of the things that really get in the way of why people make decisions or avoid certain decisions. So I want to jump right into this one. Normally you ask me questions, but I'm going to ask you a question this time. So the first one is, tell me about a time you lost money and how it made you feel.
Ooh, we're getting personal.
We are getting personal.
Losing money. So you want to talk about crypto, which is a fresh wound. So I'm not ready. But I've been dabbling in crypto. I guess we've been dabbling in crypto since 2018 or something like that. And we've certainly lost money over the years, and we've made money too, but the losses in that world are so dramatic. And it's hard to tell like when or even if you're still up. So even if you are up, even if you are like winning, it just feels so fleeting because the world is so volatile. And as far as like how it felt, I mean, there's certainly a sting to it because you just see a huge drop. It's like double digits. It's never just like 2 or 3%. It'd be like 47% in a single day. But because crypto is still like this largely optimistic asset class, it doesn't feel defeatist. Like it doesn't feel like, you just lost it all and you have no hope. And maybe it's just because I'm playing, I'm not playing with huge amounts of money here.
Yeah, I think that has a lot to do with it. Like you didn't lose it all because we didn't risk it all. We
Right.
didn't bet it all. It was more like, well, I don't really understand what's happening over here.
Yeah, but it's still a big loss.
Yeah.
Like I know this might be my toxic optimism showing its face. But I would imagine, like, to your point, if I took an L on a more stable investment, like my 401k or my primary home, I'd probably be a little more sick than I am with my crypto losses.
Yeah, and I know what that feels like. That is my version of that feeling. I will never forget it. It is burned into my memory, buying my first home. I even looked it up just to see if I could try to bring myself back to the exact time. But I bought my home, because it's public record, my first home on May 8th, 2006. And according to Wikipedia, the Great Recession began officially in around December 2007. So about a year and a half later. But I know that it felt like it was happening much sooner as I was there, because I was like, this does not feel right. The story and the romantic,
Housing always goes up.
Responsible feeling that people say comes with being a new homeowner. Like it was kind of scary going. It was kind of scary as I was kind of going through the motions. But basically, because of that, my home lost half its value, like overnight. I was waiting tables. I was going to school during the days. I was working at the school to help support myself. It was horrible. But to be fair, that was a paper loss. Technically, I didn't feel that in my wallet. I just felt it in my heart. And I remember thinking very clearly that I'd made like a really huge mistake. But I do remember the very first time you and I decided to start building our bridge fund, a brokerage account. And we spoke about that and the benefits of that in a previous episode as well. I want to say it was around the end of 2012 or something like that. But we basically maxed out every other account's contribution limits. And we needed somewhere else to park that surprise money or that surplus funds or just those little tidbits that come along to help slowly build that fund. And I was so excited about it. It was like a huge feeling of responsibility. We were just jumping in and kind of grabbing our finances by the horns, if you will. And literally the very next day, it lost. Like, I want to say we invested $3,500 and the very next day it opened, markets tanked. And it was like down to like 28. And I was like, what am I doing wrong? Do I need to second guess everything that I've ever thought I understood about money and investing? Like it was the worst.
Yeah. I was pretty broke during the Great Recession in 2007.
Well, that was normal. Most people were.
Yeah. I mean, in the sense that like I had a bunch of credit card debt and I wasn't really invested heavily or maybe even at all at that point in a 401k, certainly wasn't a homeowner, didn't have a separate brokerage account. And so for me, I saw the devastation on the news, but my closest indicator of how bad things were was the job market. And thankfully, I was still employed. So I was just kind of walking around a little naive. But fast forward to last year and that big dip that happened in March of 2020 with the shutdowns, I certainly felt that one because that was a feeling that felt very similar to what you're describing. I felt like I had made a mistake. I had just put in my notice at work and we had sold our last rental property. And so we had cash on hand. But all of the experts in the media were saying that we were entering into this recession and it was going to last, 2 years, maybe even longer. We had no idea. Nobody knew, but they all were, very vocal about their guesses. And I just remember being a little scared about it and trying like really hard to find some silver linings. Like, well, at least we'll get to save on gas money because we ain't got no commute. It was slim pickings for like the happy aspects of that time.
Yeah, I remember that. That actually brings me back to post-election, not this election, but the last presidential election.
2016.
2016. I remember there was another major hiccup in the markets. People did not know what was going to happen, but it was a very similar feeling where the markets did not really know how to interpret this news or what it meant for corporate businesses or any of that stuff. So anyway, it was really, really scary, those moments for a lot of people. I'm sure our listeners have their own version of those moments that are burned into their memory. They're uncomfortable. But I think most importantly, the challenge with those feelings is that they're discouraging. They make you not want to invest. They make you second guess your understanding of investing. And that's part of the problem because it makes people sort of stay away, avoid it, or essentially relinquish power to someone else or always look for a guru, always want to study more, learn more. And that's part of the challenge. And that's part of the reason why we wanted to talk about that today. Here's the good news. There is actually a scientific explanation for why our brains and our hearts do this to us, and it's called loss aversion theory. I feel like I'm channeling, what's that guy's name?
I don't know.
The astronomer.
Oh, Neil deGrasse Tyson.
I feel like I'm channeling Neil deGrasse Tyson a little bit.
You're going to explain some meteors in a minute?
I would love to, but I don't have, food is much more my lane. But no, so it's called loss aversion theory, and I don't want to get too scientific here. I remember one of the early times I first heard about this was actually on one of my favorite podcasts, which is Hidden Brain by NPR. And the particular episode, I believe, was recorded back in 2013. We'll link to it in the show notes. And in that episode, they explore the science behind why our brains are conditioned to remember these losses much, much more than the gains that we actually experience as well. And this is especially true when it comes to money. Now, there are other articles about this that have been written in the Washington Post and Psychology Today, and I'm sure several other media publications. It's often referred to as the culprit behind why gambling is so addictive. It's the reason why people keep trying to win and keep rolling the dice and trying to beat the house, because they're trying to make up for those losses. They remember what that loss felt like, and they're trying to like replace it with love. It's like, it's like someone on a rebound after a really bad heartbreak.
Yeah. Yeah. Speaking of gambling, fun fact, I just read an article that U.S. gambling is at an all-time high, and that nearly every state that has casinos saw its gambling revenue surpass pre-pandemic levels. So we are gambling our way through this thing to cope with COVID.
God bless America.
I know.
I love it.
But it just speaks to what you're saying. It's in our brains. It's a wiring that is not necessarily logical. But anyway, this is a little bit different from the gambling reference, which probably hits entirely too close to home for me since I just got back from Vegas a couple weeks ago. I did not lose a ton of money, but I did play a couple times when I should have walked away. But I used to work with call centers, and we actually would teach loss aversion to the trainers. Because even though the agents were incentivized to upsell and offer hotel packages and upgraded rooms, we noticed that the agents would do it until they got that first rejection. Mm-hmm. After that, they'd be hesitant to do it because they were afraid of losing the sale altogether. They were just, it didn't matter how much they would gain and how much more money they'd earn on their paychecks if it worked. They would fixate on that one loss, that one customer said no, and place more value on that than the opportunities from the other customers who might actually want a room with a view or a package.
Yeah, I'm getting anxious just thinking about it.
Yeah.
Because I'm very sensitive to those feelings of rejection. And it also makes me think about it's very similar to like stage fright. Like it's a shocking thing, and it's like, oh my gosh. But that's why we're talking about it today. Last thing, this also makes me think of behavioral economics, because I studied marketing in college, and this is a really important part of marketing when you're sort of really trying to understand the psychology of how people make certain decisions. And when you think about how lots of companies sell their products, sometimes they focus on what you as a buyer or consumer may be losing out on, more so than what the product or the service can actually do for you. And they do this because it works. And it's largely because this theory proves to be a really, really powerful motivator in a lot of people's minds. And so going back to another podcast that we recorded about knowing when to level up and lots of these courses and programs, a lot of them actually use that same approach. The first mention of how this program or book or whatever it is may be useful to you might look at, hey, here's what we have in store for you. But after that, then they start to switch a little bit. And it's like, all right, here are all the good things, but you really want to lock this in, because if not, you're going to lose out on this opportunity to save 40%, or there's only 24 hours, so you're going to have to figure something out unless you're going to be losing money.
Yeah.
And again, it kind of speaks to how the brain works and how that impacts our decisions. And
It reminds me why marketers love digital marketing, because they can kind of take that human element of selling out of the picture. These algorithms and these upsell and these urgency messaging, they don't get tired. They don't feel no shame about upselling the hell out of you until your brain starts to realize like, oh shit, I might be losing something.
Yeah.
Loyalty programs are also notorious for this. They use loss aversion as like a primary motivator to get people to renew. So they'll create these public systems that display your status, whether it's, priority boarding on the airplane, or hotels giving people with status free internet. And so even if the cost of maintaining that status, meaning you're buying a higher price flight or you're staying at a higher price hotel, even if the cost is well above the $12 that you would spend on internet or the $7 you'll spend on like an airplane bottle of wine, the idea that you might lose some perk is what drives people to spend more money.
This, to me, is the more interesting part about money. Like, I find this stuff to be way more interesting than just analyzing stock charts or company performance. I love digging into how people think and feel about money, not just what to do with it. So this all begs the question, if we know this about ourselves, if there's science to back this up, and we understand that we're wired to react differently to losses and arguably more strongly to losses than we are to gains, what do we do about this, and how do we ensure that we can overcome this sort of fear of loss so that it doesn't get in the way of us making better decisions with our money?
I think there are a couple things we can do, and you kind of hit the nail in the head when you talked about our wiring. These are well-worn neurological pathways that go back all the way to prehistoric times. And then on top of that, they're reinforced by some of the savviest marketers in the globe through digital marketing and, advertising. So basically, your brain is going to do what it does. And you almost have to rewire it and apply the same huge levels of effort to make it do something different. So one of the simple ways, I guess we should say, that we do this is we make sure to celebrate and actually document our wins. And for some people, this translates into like a daily gratitude practice. For others, it might be this physical planner that they have where crossing things off of the list gives them that satisfying feeling. For others, it's just setting big goals and knocking them down. And if you're like me, it's a combination of all of the things. But the point is, you almost have to send your brain on this new fact-finding mission and teach it to recognize and find value in something other than avoiding loss. Like burning each memory of your gains and your wins just helps to balance it out a little bit.
Yeah.
And the reps matter here. You can't just wait for the big win. You got to count all the little ones along the way.
Yeah, that's a really, really good point. I am not a journaler. Is that what you call someone that writes in a journal?
Yeah.
I'm not a journalist.
I kind of like journalists, though.
Yeah, I don't know that counts.
I know words mean things, but...
So I do not journal, but I would imagine that that's probably one of the benefits. You can always go back to those moments of loss, or in this case, to your point, celebration or gain, and really get back to how you felt at that moment. And I know that I'm guilty of this too, because I'm always raising the bar and thinking bigger and believing that more is possible. But sometimes you do have to go back and say, hey, what was the goal back then? You felt that if you accomplished this thing, you would feel amazing. And hopefully the more you do that, the more you're sort of adding a bit of a contrast to some of those negative feelings, and you can think back on the good stuff. Okay, so something else that you can do to help overcome loss aversion, and I think in terms of investing, is to be clear on your investment horizon. And so basically, there's short-term investing and long-term investing. In general, short-term is any investment that you're looking to hold on to for less than a year. A long-term investment is one that you're looking to hold on to for more than a year. And so you shouldn't be using short-term metrics for long-term investments. When I think back to my vivid memory of loss and starting a brokerage account, that's basically what I was doing. I was making a long-term investment, but I was really, really nervous and frustrated about the day-to-day fluctuations of that particular investment. And if this were a short-term investment, meaning I was looking to capitalize on that $3,500 in under a year, or let's say 3 or 6 months, then yes, that huge drop might have been something that I paid attention to, and maybe I could reconsider the type of investment that I was making. But that really wasn't the case. And so I would imagine for most people, if you're talking about your 401k or an actual retirement account, you're not planning on touching that money. You really shouldn't be so moved or so overly concerned with what happens with your investments in a day or a week or even, let's say, 3 or 6 months.
Yeah, I'm guilty of this. It's kind of like when you post something on Instagram and you just keep refreshing it to see when those likes start coming in. And like nothing is as instant as you want it to be, and particularly when it comes to your investments. So unless you're a day trader, this daily obsession of your portfolio isn't really going to be a useful or a helpful exercise.
Yeah.
And actually, to bring it back to behavioral finance, there's a term called the endowment effect that refers to the emotional bias that causes individuals to irrationally value something that they own higher than its market value. And so the endowment effect is actually triggered by loss aversion.
Oh, wow.
And a common example is when people are actually given stocks as an inheritance. So even if those stocks don't fit their investment criteria or their risk tolerance or may even be unprofitable, they just hold on to them irrationally because they value them more than what they're worth. And so it just piles onto this daily obsession, is that not only are you afraid of losing money, but you're holding on to something that isn't actually serving you. And so loss aversion here has cascading effects. It's not just about the decisions that you make in the moment, it's about the decisions that you don't make because you're valuing them more than they're actually worth.
Interesting.
Yeah. Let's take a quick break and we'll come back with a few more ways to overcome your fear of losing money. All right. So the third thing people can do to decrease their loss aversion or their fear of losing money is to pretend that you never had it to begin with. And this sounds really silly, but this is a practice that goes back to Stoic philosophy and is even a cornerstone in several religions around the world. But it's this idea that attachment to things is what causes all of our suffering. And as much as I'd love to go down a philosophical rabbit hole, because I love this kind of stuff.
You do.
I love exploring theories of the world. I'll give the simplest example related to finance that we used, which was to pretend that only one of us had a paycheck, right? We made a very deliberate decision to live below our means, regardless of how much money we brought in. And that not only helped us limit our spending, but it took away the teeth associated with losing money on investments. And it's kind of hard to feel like this debilitating loss with something that you never acknowledged as yours to begin with. You obviously feel something when it's gone, but it's not like this completely, soul-crushing failure that comes with a lot of loss.
Yeah, this is really interesting because it's making me think about the importance of word choice. If you tell someone, live below your means, they totally understand it, they've heard it, there's a bit of a cultural feel to it. It's a familiar term. But when you tell someone, pretend like you only have one check, it sounds silly.
Yeah,
even though
sounds
that's
fun.
exactly what you're telling them to do. Well, maybe it sounds fun to you.
Yeah,
I'm
I'm associating silly and fun, where it's like it's kind of playful. It's like we're just pretending. There's no stakes here.
Yeah. But I could see how someone who's super obsessed with trying to build their money would say, I'm an adult. Yeah. Don't tell me to play pretend. You know what I mean? But he would say, oh, well, we can live below your means. We're like, oh, okay, I can wrap my head around that. Yeah, it's really...
You got to know your audience.
You got to know your audience, yeah. But that's essentially what you're doing. You're playing pretend.
In many things, actually.
Absolutely.
Let's not get on that philosophical conversation. It's all made up.
Love it. Okay. Last thing that I'll mention that people can do, even though I feel like we're going to probably mention a few others.
This is definitely not the last thing, yeah.
Well, I'm looking at my notes here. This is number 4, and I don't know why. Maybe I originally planned on only offering 4. But the fourth one, and dare I say this is my favorite, and I can say from personal experience because we've done a complete 180 on this, and that is to turn off the news and all financial media. And I say this as someone that is technically a part of it, but turn it off, unplug, drop it, just take your iPhone out,
limit it,
throw it into the ocean.
Oh, man.
Just get rid of it. I would say, especially if you're a passive investor like us, and index funds make up the lion's share of your portfolio, you do not need to watch CNBC every day. You don't have to check your apps. You don't have to check the market to see how it's performing. Like, it's not. After a while, you just get a feel for it. So you don't need to plug in because they're always going to do one or two things. They're either going to fill you up with overconfidence, just heaping doses of do this thing, you're doing the right thing, or they're going to scare the living bleep out of you, right? That's their job, is to tickle those emotions, to get your attention, to keep you watching, to either do something or to not do something. And it's not to all over financial media, but you do have to understand that they have competing objectives, and their job is to keep you interested, to keep you engaged, to get you to share something, to get you to log in or to take action. But again, if you understand and you're clear on what you're doing, you've got a strategy, just keep on playing your game, mind your business, ignore the doom and the gloom, and ignore the booms. All right, that's my last one. But basically, turn it off, shut it down, figure out what times in the year you're going to take a peek and check, make your tweaks as needed, and go about living your life.
Yeah, I'd argue a more nuanced version of that tip, which is to just learn the difference between news and content.
Okay.
And I have a blog post brewing about this that I probably just need to find the time to write it. But a while ago, I read this study about Americans and their news consumption. And there was this report that found that there was a ton of confusion about which organizations generate news and original content. So it listed 6 different sources. It was stuff like ABC News, Wall Street Journal, Huffington Post, Facebook, and like 2 others. And nearly a quarter of Americans couldn't correctly identify which ones did original reporting versus which ones just published or republished content.
Yeah.
And so again, not going to get on a tangent, but knowing the difference between news and content is so incredibly important to your financial journey. I'm not here to tell you how to value the difference, but simply knowing the difference is going to save you a lot of time and money. And the way that I look at it is that news is reporting a factual circumstance, something that can hold up in a court of law, something that we can all agree on. So it's raining outside is a fact. You can all go outside and you can see liquid droplets falling from the sky, and it's usually a confirmable event that, oh yeah, that's rain. Content is when you add that seasoning and that context to the fact. And so instead of saying it's raining outside, you might say today is a dreary day, right? Rain doesn't necessarily mean dreary for everybody. Plants love rain.
I love rain.
You love rain. Mermaids love rain. I don't know that mermaids love rain, but there are lots of people that love rain. And to bring it to a financial example, news is the Dow Jones dropped 200 points today. Confirmable, factual, very to the point. Content is the stock market is reeling from today's dip.
Companies in a free fall.
Yeah. Do you see the difference? Like one is like I can literally go and count the dip and it's 200 increments versus reeling, free fall, downturn. These are all very descriptive, subjective words.
Yeah.
That's content.
Yeah, I love it. And, I'm a huge fan for that. And, that's making me think about our last podcast, or maybe it was the one before that. I can't remember exactly when, but it was about knowing when to pay, right? It's the same thing is true for news. You've got to figure out, hey, I've had enough of this content and I want a little bit more news so that I can make my own decisions. And sometimes that actually comes with a little bit of a premium. You have to be willing to pay for that. That is the world that we live in. I've got another one here. See, I knew we weren't done. And it's to invest in tools that help to minimize those losses. Look, I am not an expert on stock options. I'm sure some of our listeners are, but you guys know. And if you don't know, you do have the ability, particularly when it comes to stock options, and you can do that with other investments too, to set limits to ensure that you don't lose out on your money. There are systems and functionality in place, depending on certain platforms, that allow you to do that. So, for example, as of today, we don't hold any single stock investments. We have S&P 500 index funds. In some cases, we have growth funds, which are basically more aggressive forms of S&P 500 funds. And we have like a tiny bit of cryptocurrency, as Kirsten mentioned. The losses we may experience with the more aggressive funds or asset classes are baked into our assumptions. So if we lose that money, it's not the end of the world for us, and it doesn't take away from what we're ultimately trying to accomplish. And so this is referred to as your allocation, the percentage of funds that are allocated to, let's say, stocks versus bonds versus international funds versus, let's say, more conservative funds, et cetera. And so this is all done primarily to hedge against losses as they happened. And it's typically advised to do this multiple times throughout the year. So again, you've got your investments. There are things that you can do to help not necessarily control your losses, because you don't have full control over what your investment portfolio or what the markets are going to do, but there are things that you can do to help minimize them or ensure that they are softer than what they could potentially be if you were to play a little bit more aggressively.
Yes. And I'll just add one last tip on top of your last tip, which is along those lines. And that's simply to try to use a robo-advisor. We talked about robo-advisors briefly in episode 16 when we talked about the importance of brokerage accounts and the great debate about whether dishwashers are robots, which is still pretty much unresolved.
Nope, that's been resolved.
It's still unresolved. But robo-advisors are basically robots that come up with financial advice based on software that automatically manages and optimizes your assets with minimal human interaction.
I don't think you're selling robo-advisors very well.
I know, it's so technical.
I think particularly now, after seeing the visual of Elon Musk and Tesla
with
creating
that dancing robot.
iRobots, I think I just saw a robot do a backflip off of a crate the other day.
But it wasn't a robot. It was a person dressed as a robot.
Too close. Too close for comfort.
Anyway, the algorithms in robo-advisors, the actual robots, are better suited to react to bumps in the road and rebalance your accounts automatically to minimize your costs and your losses. If you visit richandregular.com, we actually have a few brokerages listed on our resource page that do this. Acorns, M1, Personal Capital are a few. And then we have some more listed on our resources page. So go there if you're interested in trying robo-advisors.
Yeah, I am slowly but surely becoming a huge fan of robo-advisors. And I think over the next 5 years, for sure, we're going to see a lot more resonance and acceptance of them for this reason. Because I think what they're doing is relieving people of all of the emotional work, right?
Yeah.
That fear. It's like a bit of a cheat code to say, all right, well, you struggle with managing your emotions and losing money. Give it to this machine or what you call a robot that has no feelings.
Yeah.
Let it do the math. Let it crunch based on historical data. Let it do all of those things for you so that you can be emotional about things that you actually have control over.
Yeah. And the more that younger, more retail investors come into the investing scene, the more that this will just be a default option on apps and they won't know the difference, very similar to any other platform that we use where an algorithm controls what you see. Like, it'll just be the norm.
Yeah.
And more people will start to use it.
Great. All right. Well, let's wrap this one up. What are your closing thoughts?
My closing thought is that the real key, I know we've listed like 6 different things, but the real key to overcoming your fear of loss is to actually believe in your ability to rebuild and to believe in your own resilience.
I feel like you're channeling Brene Brown.
I am. Y'all know my closing thoughts are always about psychology and mindset. But you've probably heard that loss is inevitable. And, for some people, that message is fatalistic. And the immediate reaction is just like, well, then what's the point of it all? But if that's you, I encourage you to lean into that question and explore, Stoicism and Buddhism and a number of other philosophical and spiritual pursuits that try to answer it. Or you can figure out where your attachment to things comes from to begin with. But the reality is all roads lead back to you. So the key to overcoming your loss is to do your work. Become a journalist.
Journaler. Journalite.
Journalite.
I love it. My closing thoughts are similar. You mentioned that word inevitable, and yes, loss is inevitable. If anyone tells you that they have a perfect investment that's guaranteed to increase and you will never lose money, you should close your laptop, tie your shoes, and run in the opposite direction as fast as you can. Loss is inevitable. It happens. But it's also natural and it's completely normal to feel terrible when you experience it. We just spoke about a bit of the science behind it. This is baked into how your brain works. But we shouldn't let that fear of losing money overpower our investing or wealth building intention. So hang in there, stay the course, celebrate the wins along the way, and hope that they drown out the bumps that you are inevitably going to experience along your journey.
Love it. Well, thank you for listening to another episode of the Rich and Regular podcast presented by Success. If you'd like to add to our documented list of wins, head on over to the rating and review page and leave us a 5-star rating and review. We'll see you next week.